Have you ever opened up a company's financial report, especially from one of the big players, and just felt kind of overwhelmed?
Oh, absolutely. All those numbers, the
Yeah,
acronyms.
the jargon. It
Yeah,
feels like you need a special decoder ring sometimes.
exactly.
But what if you could just cut through all that noise and get straight to the important stuff, the surprising bits, and actually understand what's going on?
Well, that's the goal, right?
Precisely. Welcome to the deep dive. Today, we're putting Welltower's second quarter 2025 performance report under the microscope.
And it's not just about reading off the numbers.
No, definitely not. Our mission here is to really unpack this report for you, pull out the key insights so you can quickly get a handle on Welltower's health, where they're headed.
And cut through that jargon we mentioned.
We will. We'll reveal the real story behind the figures and what it means for, the whole healthcare infrastructure space. Okay, let's dive in.
So looking at Welltower's Q2 2025 results, some numbers immediately jump out. Really strong performance, particularly if you look beyond just a standard net income line.
That's right. I mean, they reported net income attributable to common stockholders at $0.45 per diluted share, which is, one figure.
Hmm.
But the number that really catches the eye is their quarterly normalized funds from operations FFO. That hit $1.28 per diluted share.
And that's a key metric for REITs, for real estate investment trusts.
Exactly. For you listening, FFO helps measure the actual cash generation capability, sort of adjusting for accounting rules like depreciation. And that $1.28 figure, that's up 21.9% from last year.
A huge jump.
Yeah, a really significant increase. What does that FFO leap really signal to you?
Well, it's a powerful signal, definitely. It tells us Welltower is generating a lot more cash from its core business,
Yeah.
which points to a very healthy, very agile financial position.
Right.
And you see that agility showing up in their portfolio strength, too. Their total portfolio delivered year-over-year same-store net operating income, or SSNOI, growth of 13.8%.
Okay, SSNOI. Remind us what that same store part means again.
Right. So think of SSNOI as the organic growth from their existing properties. It strips out the noise from, say, properties they just bought or just sold. It's looking at the core, consistent portfolio.
Got it. So the properties they've held onto for a while are really performing well. And what's the main driver behind that overall 13.8% SSNOI growth?
The big engine here is undoubtedly their seniors housing operating portfolio. They call it SHO. That segment delivered an amazing 23.4% SSNOI growth.
Wow, 23.4% just from SHO. That segment's clearly firing on all cylinders.
It really is.
So digging into that a bit,
Yeah.
how did they pull off such strong performance in seniors housing?
It really boils down to a couple of key things. First, a 10.1% year-over-year increase in same-store revenue.
Okay.
And that revenue boost was fueled by a 420 basis point jump in year-over-year average occupancy.
420 basis points. So that's 4.2 percentage points higher occupancy.
Exactly. More people in the beds. And on top of that, they also saw 4.9% growth in revenue per occupied room, or RIFPR.
Right. So more residents, and they're getting more revenue from each resident. How did that play out on the profit side?
Crucially, that RevPR growth, the revenue per room, it significantly outpaced their expense per occupied room, their XPR.
Ah, okay.
So revenue per resident grew faster than cost per resident, and that led to a really healthy 330 basis point expansion.
Yeah.
That's 3.3 percentage points in the SHO portfolio's SSNOI margin.
So they're not just filling rooms, they're doing it very profitably. That sounds like strong management.
It really indicates strong operational efficiency, yes.
And in moving beyond the operations, their actual financial foundation looks like it's getting stronger too.
Definitely.
Their net debt to adjusted EBITDA ratio, that's a key leverage measure, it improved quite a bit, down to 2.93 times at the end of June 2025 from 3.68 times a year ago.
That's a significant deleverage.
Yeah, and their adjusted fixed charge coverage ratio, which shows, how easily they can cover their debt payments that also climbed, up to 6.33 times from 5.09 times. What do these ratio improvements tell you specifically?
Well, these are really important signs that Welltower is actively strengthening its balance sheet. They're reducing debt relative to earnings and just generally boosting their capacity to handle their financial obligations. It really suggests a very disciplined capital management strategy.
Makes sense.
And backing this up, they've got about $9.5 billion in available liquidity.
Wow.
Yeah, that includes $4.5 billion in cash and restricted cash, plus they have their entire $5 billion credit line available. That's a substantial safety net.
And it sounds like they're putting capital to work too, not just shoring things up. They mentioned $9.2 billion in investment activity so far this year.
That's right, $9.2 billion pro rata year to date, with $3.7 billion actually closed in the first half of the year. And they've also been smart about sourcing capital, over $4 billion raised at attractive prices.
How so? What kind of capital?
Well, strategically, they issued some senior unsecured notes, $600 million at 4.5% due 2030, and $650 million at just over 5% due 2035. Plus, they assumed some debt that was below current market rates. Smart moves.
Okay. And reflecting all this positive momentum in financial health, they boosted the dividend.
They did. The board announced a 10.4% increase in the quarterly dividend, up to $1.74 per share. And get this, it marks their 217th consecutive quarterly cash dividend.
217. That's quite a streak. Speaks volumes about consistency.
Absolutely. Real confidence in their cash flow.
Okay, so we've run through some really powerful numbers here, painting a pretty positive picture for Welltower. But to really understand the full impact and why these numbers matter so much in the real estate world, we definitely need to decode some of that special language they use.
Right, the jargon factor again.
Exactly. Like we started with FFO. Why do REITs like Welltower use terms like FFO and SSNOI instead of just sticking to standard net income like other companies?
That's a really crucial question, and it comes down to the unique nature of real estate assets. Standard accounting rules, U.S. GAAP, they assume buildings lose value over time through depreciation, right? Like a machine wearing out.
Yeah, makes sense for most things.
But real estate often doesn't work that way. Buildings can hold their value or even appreciate. So that depreciation charge on the income statement is a non-cash charge. No actual money leaving the building, and it can make earnings look lower than the operational reality.
Ah, okay, so it distorts the picture a bit for real estate.
Exactly. So the industry group, Narrate, created funds from operations FFO as a supplemental measure. It basically adds back that depreciation charge and some other non-cash items to net income. It gives you, the listener, a clearer view of the actual operating performance, the cash being generated by the properties.
So FFO gets you closer to the real operational cash flow.
Got it. And then they also talk about normalized FFO. What's the difference there? Is that just another adjustment?
Yeah, it's a further refinement. Normalized FFO adjusts for certain specific items that might be non-recurring or unusual in a particular quarter, things that could maybe skew the FFO number for that period.
So normalizing it helps you make more consistent comparisons, quarter to quarter, year to year, and also compare Welltower more easily with other REITs. Both FFO and normalized FFO are tools to understand that true cash-generating ability, getting beyond just the standard accounting income.
That makes perfect sense. Okay, then we also talked about net operating income NOI and especially same-store NOI, SSNOI. We touched on SSNOI being about organic growth. Can you elaborate on that distinction?
Sure. So net operating income, NOI, is pretty straightforward. It's just the property's total revenues minus its direct operating expenses. Think of it as the property's profit before you account for debt payments, taxes, and depreciation.
Right, the profit from running the building itself.
Exactly. But the same store part of SSNOI is really key for analysis.
Yeah.
Like we said, it filters the portfolio. It only includes properties that Welltower has owned and operated consistently for both periods being compared usually a year or more.
So it throws out the brand new acquisitions, the major redevelopments, the properties they just sold.
Precisely. It strips away all that noise from portfolio changes. It lets you see the true underlying performance trend of their established ongoing assets. It's like judging a retail chain based on how its existing stores are doing, not just by how many new stores it opened last month.
That's a great way to put it.
Right.
And apples to apples look at the core business performance.
You got it.
Okay, and specifically for their seniors housing operating segment, the SHO segment, they use RevPOR, revenue per occupied room, and ExPOR, expense per occupied room.
Yeah.
How do those specific metrics help us evaluate that part of the business?
Yeah, these are absolutely critical for analyzing seniors housing operations, mainly because they focus on the performance per occupied unit. It takes the occupancy rate out of the equation for a moment.
Okay, so it's not about how full they are, but how well they perform for the rooms that are full.
Exactly. RevPOR is the average revenue they generate each month for every room that's occupied. And XPR is the average monthly expense for each occupied room. So these give you direct insight into the revenue potential and the cost efficiency of their SHO operations. By seeing how much they make and spend per resident, Essentially, you can better evaluate the quality of their operations and their ability to manage margins effectively.
That makes a lot of sense. It isolates the unit economics. And finally, just to circle back on those leverage and coverage ratios, we mentioned net debt to adjusted EBITDA and adjusted fixed charge coverage. Briefly, what's the takeaway for us on their financial stability from those?
Sure. These are basically your fundamental indicators of credit strength, of financial health. Leverage ratios, like net debt to EBITDA, tell you how much debt the company is using relative to its earnings power. Lower is generally better.
Less reliant on debt.
Right. And coverage ratios, like the fixed charge coverage ratio, show how easily the company can meet its debt obligations, interest payments, principal, etc. Higher is better there.
More cushion to pay the bills.
Exactly. So the fact that Welltower improved these ratios like net debt to EBITDA going down from 3.68x to 2.93x signals a stronger, more resilient financial fit. It shows they have a very solid capacity to handle their commitments, which is, obviously reassuring.
Definitely. But it is important to flag, and the report itself points this out, that these metrics, FFO, SSNOI, NOI, they aren't official U.S. GAAP measures of net income or cash flow.
That's a crucial caveat.
Yeah, they shouldn't be seen as replacements for GAAP numbers, but more like additional tools specifically designed to give extra insight into this particular sector, real estate.
Exactly right. They offer a more complete, more nuanced view, tailored specifically for analyzing REITs. And speaking of their view, looking forward, Welltower actually revised its guidance for the full year 2025, reflecting this confidence we've been talking about.
They did, yeah, and it's an upward revision across the board. Their guidance for net income attributable to common stockholders is now $1.86 to $0.94 per share. That's up from $1.70 to $1.84 previously. And their full year normalized FFO guidance also got a bump. Now they expect $5.06 to $5.14 per share, which is up from their earlier range of $4.04 to $5.04. That feels like a pretty clear positive signal from management, wouldn't you say?
Oh, absolutely. When management raises guidance like that mid-year, it shows they're seeing continued momentum and they expect to perform better than they initially thought.
Right.
And they're also projecting strong blended SSNOI growth for the full year, expecting it to land somewhere between 11.25% and 13.25% on average.
And within that blend, is SHO still the star?
Looks like it. They expect the seniors housing operating segment to lead the way with roughly 18.5% to 21.5% SSNOI growth for the year. Really strong.
But the other segments look positive too, just maybe not as explosive. Seniors housing triple net around 3.5% to 4.5%. Outpatient medical at 2% to 3%. And long-term post-acute care also in that 2% to 3% range. So it seems like broad-based growth expectations.
That's right. Not just relying on one segment. And in terms of what they'll be doing with capital for the rest of the year, they plan to fund about another $212 million in development for projects they already have in the pipeline.
Okay.
And they also expect to sell some properties and get some loans repaid, generating about $340 million in proceeds over the next 12 months at a pretty decent blended yield of 6.9%. So it looks like some strategic capital recycling is also part of the plan.
Okay, so we've spent a lot of time digging into the impressive numbers and the specialized terms that help us make sense of them. But let's zoom out for a second. At its core, who is Welltower? What really defines them beyond these quarterly reports?
Well, Welltower Inc., ticker WELL, on the New York Stock Exchange, it's an S&P 500 company. And they don't just call themselves a real estate company, interestingly. Their own description is one of the world's preeminent residential wellness and healthcare infrastructure companies.
That's a very specific framing. Residential wellness and healthcare infrastructure.
It is. They really emphasize their focus on a particular intersection. They position their huge portfolio over 1,500 seniors and wellness housing communities right at the crossroads of housing, healthcare, and hospitality.
So it's not just about providing buildings.
No, their stated goal is about creating vibrant communities, specifically for mature renters and older adults in the U.S., the U.K., and Canada. And alongside that, they also provide essential infrastructure for doctors in their outpatient medical buildings.
Okay. And you mentioned something earlier about how they see themselves a product company.
Yes, and this is what I find really distinctive, and maybe it's part of the key to their performance. They explicitly view themselves not just as managing real estate assets, but as a product company in a real estate wrapper.
Product company in a real estate wrapper. What does that imply to you?
It suggests a focus that goes beyond just the physical buildings. It implies they're thinking about the resident experience, the services, the community aspects, developing a product that people want. It's driven, they say, by relationships and an unconventional culture. It sounds much more dynamic than just traditional property management.
Almost like a tech company mindset applied to real estate and healthcare infrastructure.
Sort of, yeah. And they say they back this up with specific strategic pillars, like a disciplined approach to allocating capital, which is powered by their own data science platform.
Okay, using data science.
Right, and achieving superior operating results, driven by something they call the Welltower Business System. It all seems geared towards their ultimate goal, what they call their North Star,
And their North Star is?
to deliver long-term compounding of per-share growth and returns for their existing investors. That's their stated prime directive.
Okay, so wrapping things up here. Our deep dive into Welltower's Q2 2025 report really shows a company firing on multiple cylinders. Very robust financial performance, especially that strong growth in seniors housing operating.
Yeah, and hopefully we've helped decode some of those key real estate metrics for you, FFO, SSNOI, RevPOR, so you understand why they give a clearer, more powerful picture of how a company like Welltower is actually doing operationally.
Absolutely. We've also seen their confident outlook for the rest of 2025, with that upward guidance revision and clear plans for investment and managing their portfolio.
And finally, we touched on Welltower's core identity, not just a REIT, but this unique healthcare infrastructure company with that intriguing product company philosophy.
Right. So this deep dive hopefully has given you a much clearer, more informed perspective on a really major player in the healthcare real estate world without you getting bogged down in all the complex details.
You should now have the tools to understand not just what happened in their second quarter, but maybe more importantly, why it matters and how their unique approach might be contributing to these strong results.
And maybe we can leave you with a final thought to chew on. Welltower explicitly states its North Star is long-term growth for shareholders, and they pursue this partly by seeing themselves as that product company in a real estate wrapper.
Mhm.
So think about this. In a world where healthcare needs are changing so fast and demographics are shifting dramatically with aging populations, how might that product company mindset applied to healthcare infrastructure actually reshape the future of wellness and senior living? What new opportunities, or maybe even what new challenges, could that innovative approach create for the whole sector?